My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, it's not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Today may have looked sedate on the surface. Dow gaining 38 points, S&P backsliding a small amount, 0.01%, NASDAQ declining 0.19%. But underneath, we saw a radical revaluation of all sorts of stocks. Yep, we were forced to reconsider how much we're willing to pay for certain stocks now, how much we'll pay for a certain amount of growth now, and how much we will pay in the future, or do we sell? The most dramatic example, this morning, an activist firm with a brilliant reputation, Elliott Management, took a $3.2 billion stake in AT&T, gigantic, and sent a letter to the board of directors with a plan to unlock value. Stock currently trades at just under 37. They think they can get it to $60 plus by the end of 2021 if the changes are made, and that would be huge. AT&T's been a real long-term laggard. Elliott blames the underperformance on some ill-advised decisions by management, like overpaying for DirecTV, which is losing subscribers, along with a failed acquisition of T-Mobile, which ended up jump-starting their competitor with a gigantic breakup fee. But with some changes, Elliott argues that AT&T could be worth a great deal more than what it's currently selling for. Specifically, they want the company to divest itself from distracting side businesses, cut the fat, for heaven's sake, emphasize some winning entertainment assets, and stop doing these willy-nilly acquisitions at every turn. Put it all together, and these activists believe that the stock could get a much higher price-to-earnings multiple. Notice, I didn't say Elliott's calling for the head of CEO Randall Stephenson. They didn't ask for board seats. That's astonishing. Elliott's known for hardball tactics. They once confiscated warship from Argentina to collect what they thought they were owed. They were owed it. In reality, though, you know what? I think this reputation is entirely overblown. Elliott's actually quite constructive if you're willing to work with them. But they're really showing a lot of confidence in AT&T here. They've presented a totally reasonable roadmap for attracting more institutional investors. The stock has a surprising few number of them, and therefore sending the stock higher. It shouldn't be that hard given that AT&T sports a bountiful 5.5% yield. They're paying it away for the changes. So why isn't the stock already a lot higher? Well, Elliott blames poor management. Stock market has judged AT&T's leadership team and found it wanting. If they change their strategy, the stock could catch fire. Notice it didn't say if they changed the leadership, just if the leadership changed the strategy. Again, I thought it was very gentlemanly, even though I know many home gamers own AT&T because of its iconic reputation, big dividend. Hedge funds have shunned this stock because of management's missteps. But if Randall Stephenson embraces Elliott's plans, and the company has said that they already kind of agree with a lot of what Elliott wants to do, then the stock could be worth buying, even after today's run. AT&T stock's still lagging well behind the rest of the market, and if they can get their house in order, I think you could end up looking very cheap in this environment. So, yes, I say it's a buy. Emphasis on, though, is this environment phrase that I just gave you. Because we're seeing a wholesale revision of what's considered safe and cheap versus what's considered problematic and expensive here. Something is roiling the entire market underneath. While it's been going on now for a week, it's impossible to deny that we are seeing an avalanche of selling in the high flyers as money managers swap into the cheaper, slow and steady names like AT&T. Today, we saw a wholesale breakdown in super growth names as money rotated out of these now former market darlings into laggards. Laggards is actually a little comforting given the sell-off. So look at Shopify, which is one of my absolute favorite companies. Helps small businesses harness the power of e-commerce. Business is so good that earlier today, just this morning, Baird rolled out an extremely bullish piece of research where they raised their sales estimates. Shopify's got phenomenal revenue growth. There's only one problem. It doesn't have much in the way of earnings. This $358 stock, down from $406 a few weeks ago, it's expected to earn roughly 70 cents a share for 2019. So even though it's got explosive growth thanks to a terrific secular trend, Shopify is absurdly expensive on an earnings basis. And the market's no longer willing to pay up, which is why the stock plunged another 5.7% today. And at least it's got some earnings. It could be worse. Late last week, CrowdStrike, the cloud-based cybersecurity play, reported a fantastic number. Fantastic. And even raised their earnings forecast. Unfortunately, the company still expects to lose money. Suddenly, this market doesn't want to see some losses, and they've got some newfound competition. Instead, it just wants cheap stocks and ones that are turning a bountiful profit. Hence why CrowdStrike nosedived nearly 12% today, on top of Friday's hideous declines. People are really losing money here. Later tonight, we'll hear from two other stocks that are selling off because of this exact rotation, Alteryx and Zoom Video. Both companies reported incredible quarters. It's not the fault of the companies. It's the fault of the stock market, okay? The market doesn't know what to do with these stocks. So what's now in style in the Wall Street fashion show? Money managers want stocks like Citigroup with a 3% yield that's trading at 9 times earnings. They want Goldman Sachs, which has a smaller yield with a faster growth rate, also at 9 times earnings. They price JP Morgan, even though it sells for 11 times earnings, because it's doing so well. It's the best run bank in America. It's not just the banks. The stocks of the real down and outers, the oil companies, rally too. Everything from Schlumberger, the oil service giant, to Apache, the independent producer that's widely disliked, or at least it was. Both stocks pay bountiful dividends with yields in excess of 4%. Hey, speaking of the oils, we own BP from my charitable trust. You can follow along at actionalertsplus.com. Yields 6.6% and actually has growth. But I don't know if I want you in
the House of Pain.
So what's driving this rotation? Two things. People seem to believe we could see some progress in the trade negotiations with China. Personally, I'm skeptical. More on that later, but hope spring is eternal. And on top of that, there's a belief that the Federal Reserve has no choice but to cut interest rates after Friday's not-so-hot unemployment number. Once rates are cut, the bulls wish that the economy will get stronger, which is why the long-term bond yields surged today. Also, it might explain that rally in oil, although that could just easily be because the Saudis might cut back. And when money managers see a rally in oil, they assume the economy's improving. So they buy the retailers, the down and out retailers, not just the watch retailers, as if higher gas prices somehow bring in more shoppers. But since I'm no longer running a hedge fund, I'd like to be contrarian at this moment. You don't need to chase these rotations because you don't have rich investors breathing down your neck, pushing you constantly for outperformance on a daily basis. You can afford to buy what the money managers are selling, although I wouldn't sell what they're buying because those stocks are way too cheap to ignore. We're still not yet at a level that can necessarily sustain a real bottom in the turbocharged growth stocks. Some people are just beginning to realize the sell-off started. But remember, if long-term Treasury yields keep climbing, the presumption will be that the economy is doing better. And in a better economy, investors abandon these secular high-powered growth stocks for the cyclicals, the oils, the banks, and the old tech stocks, like what they bought today. I think it's wrong. The truth is high growth never really goes out of style for long. It just has periodic hiccups that shake out the weak-handed shareholders. That's what's happening. So if you haven't already found a terrific cloud stock you want to buy into weakness slowly, please, maybe you want to think about Cramer fave Salesforce, just reported a great quarter, or Okta, which has cratered despite its dominant position in the high end of cybersecurity. Or maybe you want to listen to one of the two companies I have on tonight that are high growth and think that you get comfortable with one of those. The bottom line, you want to know why your growth stocks are getting annihilated, right? It's because there's a market-wide rotation out of these companies. Hey, by the way, that is exactly why we play MI Diversified, so that on days like today, you won't have all of your eggs in one high-flying and now yolk-filled basket. Let's go to Rich in California. Rich.
Big thank you, Jim Cramer. Really appreciate everything you do. My question is about Ulterior Group, stock ticker MO. I purchased the stock about 3 weeks ago, and I was hoping for good news on the merger with Philip Morris. Stock price has a medium target of $57 and, a nice dividend yield. However, with today's news, with the FDA issuing a warning letter to Juul, I'm concerned about their marketing practices. Should I be concerned for choppy stock prices ahead?
I think you just kind of lay low here. The Juul stuff was pretty devastating. I know the Juul people are always anxious to say that what they do is they help people get off of smoking. The FDA seems to be a little more concerned about people getting on smoking. And that is something that the Juul people will deny. But you know what? Juul does not run the FDA. Let's go to Chuck in Washington, please. Chuck. Chuck?
Hello.
Hey, Chuck. How are you?
I'm great. How are you doing today?
I'm doing good, thank you. What's going on?
Good. Hey, I appreciate your enthusiasm, your candid advice, and especially your wit.
Thank you.
Presently, my wife and I are retired. We're drawing retirement, and our stocks are managed by another financial group. But this is the first time we want to try managing our own little portfolio.
Okay.
And there's something I've been watching, and I've got a gut feeling about it. We both like it, SMG.
Scotts Miracle-Gro. Scotts Miracle-Gro is an excellent company. I wish it were down a little more from its high, but they had a good selling season, and I think that you can tell that. But here, let's put it this way: if you're going to start a portfolio, I don't necessarily think you should start with a stock that's expensive, that doesn't really have the dividend protection that you might want. You're retired. You don't want to start going for what some people feel is a bit of a gunner stock. Good company, a little rich, but thank you for the kind words. Let's go to Fred in New Mexico. Fred.
Hey, Jim. I've been a holder of Corning for many months, and I've been riding this slow roller coaster, wondering when the fact that they make the glass for tens of millions of mobile phones in the world, when are we going to see some growth happen in that stock, or what is the problem with that stock when we know we have to migrate to 5G in the upcoming years?
I know. It never seems to be able to break out. It's almost as if all the holders who bought it in 1999 are still stuck in it. I think it's a slow and steady wins the race stock. I don't think it's a dangerous stock, but I don't think it's breaking out here. Let's take one more. Let's go to Ben in California, please. Ben.
Jim, what's going on, brother?
Not much. How about you?
I'm good. Question is on Slack. They had their first earnings since their direct listing last Wednesday. Initially, after earnings, the stock dropped about 15% after hours. Then Thursday, it bounced back to 30, and then Friday it dropped, and today we're down another 10%. I got in shortly after the direct listing, but what do I do here? Do I cut losses?
I have to tell you, this stock is in all the wrong hands. It just is not doing nearly as badly as people think. I totally respect Microsoft, but I do think that Slack has got great technology, and I think a lot of people like their software. I use it. But all I will tell you is that this stock, like many of these high-growth stocks that do not have earnings, is for sale, and I don't know when they're going to stop. But, boy, it'll be very clear. They'll at least bounce. And I would not sell work, so to speak, that's what the symbol is, if I owned it. But be aware, the sellers are just gunning for these stocks and moving into the lower multiple price range, and that's a rotation that is severe enough for me to tell you to be careful. All right, I like the company. I'm not changing my mind on it. I like the company. The stock itself is just in the wrong hands. We've been seeing a wholesale revision of what's safe and cheap, and that's why your high-growth stocks like a Slack aren't working. Don't take the rotation personally, please. Oh, man, buddy, tonight, Zoom Video crushed earnings, but the stock's been getting crushed. I'm going to get to the bottom of the climb with the CEO. Then, as Dollar Tree braces for new tariff-related expenses, does the stock remain a bargain, or did you miss the discount? I sat down with the CEO of one of the remodeled stores, and it's a stock that's up over 100% this year alone, and it may not be on your radar, although because it's up 100%, it's for sale. I'll reveal the name and see if that decline will continue. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.